Good morning, dear students. I welcome you all to the first session of your second semester class. So, this is the subject financial management. So, it is basically a soft core paper. So, as you all know, it is a specialization paper in finance. So, it is basically for comprising of three blocks, that is 12 units together. So, and financial management, dear students, happens to be a combination of theory as well as practical sessions. So, myself, Dr. Sukanya, I will be handling this paper, financial management, for you. So, as we know that in financial management, we will have a combination of theory and problems. So, we will concentrate more on the practical session. So today, in because it is the first class, I will start with the introductory part of financial management. Later on, we can start with the problems as such. So, dear students, the moment you hear the word financial management, it is all about finance. As you all know, finance is considered as the lifeblood of an organization. What do you mean by lifeblood of an organization? See, firstly, all of you, please remember that now how oxygen is required for the human body. Now, you know that only if there is sufficient oxygen in our body, then a human being can be healthy. Similarly, when it comes to any company, it may be a small company or it may be a well established company. So, whatever it may be, a small or a big company, but it requires finance. So, finance is like a blood, a lifeblood for a company. And if there is no finance, an organization cannot survive. So all of you, please keep in mind that it financial management is a subject basically which deals with finance. And now let us see what is the meaning of the word financial management. Dear students, see, although a company may be having finance, it may be having huge amount of money, but still managing that finance is not at all an easy joke. Okay, so you know that management of finance is really a complex procedure, and today a financial manager will be having a lot of responsibilities. He will be having a lot of initiatives that he has to take with regard to managing the finance. So here, when we look here, it means to say financial management is mainly concerned with procurement of funds. What do you mean by procurement of funds? Procurement of funds is nothing but you have to get the required funds for the business. So, dear students, please keep in mind, as I told you, financial management is mainly concerned with procuring the required funds. That means to say you have to get the required amount of funds that is required for the business. That means to say, see, a financial manager, he has to decide how much of funds will be required for the business. And all of you, please keep in mind, see, there may be two types of funds that are required by a business. Okay, so one is the short term finance that is required, a short term, or it is also called as the working capital funds. Now, working capital is nothing but the money that is required for meeting the day-to-day expenditure of the business. Now, let us say it is an industry. Now, they have to purchase the raw materials. They have to convert the raw materials into finished products. They have to pay for the electricity bill. They have to pay for the wages of the employees. So all these are the expenses that have to be met on a day to day basis. So please keep in mind, finance is required for meeting the day to day requirement of the business, okay, which is called as working capital. Or you also require capital, I mean funds or finance for meeting the long term requirement. That means to say, dear students, let us say if you are thinking about purchasing a machinery. So you know that a machinery happens to be a fixed asset, so you will require huge amount of finance, okay, for purchasing the machinery. Or let us say when you are starting your company, you will require building. So building again happens to be a fixed asset. So, what I'm trying to tell you is finance will be required for meeting the long term capital requirement as well as for meeting your day to day expenses, which is called as working capital. Now, you'll be having a chapter called as capital budgeting. In that, you will be seeing how the financial manager has to make decisions with regard to the long term capital requirements. That means, as I was telling you, it may be plant and machinery, it may be with regard to buildings, it may be with regard to furnitures, etc. But one thing that you should keep in mind is when you use the word financial management, it is basically concerned with procuring the funds. That means you have to get the required amounts of funds. And dear students, it is not just important that you procure the funds, but you also have to effectively utilize the funds in the business. Okay, so now see, getting 50 lakh rupees and getting 1 crore rupees may be a problem for the financial manager, but once he gets that amount of money, it is very important that that money has to be efficiently utilized. Okay, so there should not be any type of wastage, so the resources has to be efficiently utilized for the business. So for a financial manager, actually it is a very tough job, since he has to look into procuring the funds and also for the efficient utilizing of the money that he has procured. So, dear students, financial management is a part of management activity which is concerned with planning, organizing, directing, and controlling the financial resources. So, as I told you, it is not just important that you get the required amount of funds, but along with that, you should know how to efficiently utilize this money so that it will be very convenient and it will be very judiciously utilized so that the company can be carried out in a systematic manner. So, dear students, please keep in mind, as I already told you, the main thing that you should remember is that finance is the lifeblood of an organization. If you don't have finance, definitely you cannot run your business. Okay, whether it is a very big business or whether it is a small business, you will not be in a position to run the business if you do not have sufficient amount of funds. And then, dear students, now there is another topic which is very much there in your material, which talks about the finance functions. What do you mean by this finance functions? Now, dear students, just now I was telling you that for any financial manager, it is important that he is going to procure the required amount of funds. Not only procuring the required amount of funds, he has to utilize the funds in the efficient manner. Now, let us see what are the finance functions that have been involved. Dear students, the first point which shows about the finance function is forecasting the financial requirement. What do you mean by forecasting the financial requirements? Dear students, please keep in mind, as a financial manager, he has to estimate what is the amount of money that is required for meeting the fixed capital and working capital requirement. That itself means to say that it is forecasting the financial requirement. That means, as I already mentioned to you, please keep it in mind that a financial manager has to see what is the required amount of money for meeting the fixed and working capital requirement. Dear students, what is the difficulty in forecasting the financial requirement is that, see, any firm for that matter, it should not have surplus funds. Okay, that means to say having funds more than what is required. That is also dangerous for the company, and it should also not have deficit funds. That means it should not have shortage of funds. Why a firm should not have surplus funds? Now, let us say a company is having more funds than what is actually required, then there may be chances of spending that money in a unsystematic manner. Okay, like see, if we don't plan for our personal finance, okay, what will happen? We may be wasting that money. Similarly, in any company, there should not be surplus funds, because if you have extra funds, there may be chances of extra spending habits. That is why a financial manager should decide how much of funds will be required. And on the other hand, even if they have deficit funds, that will also prove to be a problem for the organization, dear students, because if there is deficit funds, it can prove to be dangerous for the firm. That means, now let us say you need money, as I already mentioned to you. Okay, finance is the lifeblood of an organization. Now let us assume that you're not having sufficient funds for meeting your day-to-day working capital requirement. Now, if you don't have money for meeting your day-to-day expenditure, how will you be in a position to run the company? It will not be possible. So that is why, dear students, all of you, please keep in mind the first very important function, which says forecasting the financial requirement, is nothing but it means to say that a financial manager should decide about what will be the adequate amount of funds that is required for running the business. It should not be over and above the requirement. There should also not be a shortage in the financial requirement of a firm. So that is very important. Dear students, going to the next very important point, it says deciding about the capital structure of the firm. Dear students, please keep in mind the capital structure of a firm is a very important component. Why? Because how exactly you are going to design the capital structure of a firm is a very important component. Now, you may be wondering, what do you mean by this composition of capital? So, you people might have heard about equity capital, preference share capital. You have also heard about debentures. Dear students, let me tell you very clearly, it is very, very essential for all of you to know the basics of equity shares, preference shares, and debentures, because only then you will be in a position to work out the problems with regard to capital structure decisions and so on. Now, what do you mean by deciding the capital structure? So, as I told you, it is deciding about whether you are going to raise the capital required for the firm through equity shares, or you're going to use preference shares, or will you be using debentures, or will you be using a combination of different capital. Now, dear students, all of you, please keep in mind, as you would have already learned in your PUC and your degree about equity shares, preference shares, and debentures. But once let me mention to you about it. Dear students, all of you, keep in mind equity share capital is nothing but the ownership capital. That means to say, now let us say one ABC company has to be started. Now, what this ABC company is going to do, it is going to think of raising the money with the help of issue of equity shares. When the company thinks of issuing the equity shares, now let us say I go and invest money in that ABC company, and if I purchase the equity shares of that company, I will be giving money to the company. Why? Because I'm purchasing the shares, so I'm giving money to the company, and that company will utilize that money for meeting the capital requirements. But please keep in mind, once I invest money and purchase the equity shares of the company, I am the shareholder of that particular company. So when I am the shareholder of that particular company, it means to say that I have the ownership rights, okay, of that company. That means to say I am a owner, I am a part and parcel of that company, because I have purchased the equity shares. And once I have invested in equity shares, I will be getting a share in the profits of the company in the form of dividend. I hope you all are understanding. So please keep in mind the basics of equity shares, preference shares, as well as debentures you need to know. Otherwise, you will not know anything with regard to the problems. So as you all know, equity shares happens to be the owner's capital, ownership capital. So once I think of investing money in the equity shares of a company, I am owning the shares of that company. So it means to say I happen to be the shareholder of that company. Okay. And that company will generally be giving me a share in the profits in the form of dividend. That is also another thing that you have to keep in mind. The next thing, dear students, is about preference shares. Now, what do you mean by this preference shares, and what is the difference between equity shares and preference shares? Now, dear students, preference shareholders, as the name itself indicates, preference means importance. Okay, so the importance that has been given to the preference shareholders. See, a company will have to pay a fixed percentage of dividend to the preference shareholders every year. Okay, so there will be a fixed percentage of dividend that has to be paid to the preference shareholders, whether that company is in a position to make a profit or not. Only after giving dividend to the preference shareholders, if any profit is remaining, only then they can think of distributing that dividend to the equity shareholders. Not only that, dear students, whenever you purchase preference shares, a company, whenever it is thinking of closing down, when the company is closing down, first the settlement towards the preference shareholders has to be made first, and then the settlement towards the equity shareholders will have to be made. So all of you keep in mind that equity shareholders are the owners of the company, and they will be declared a dividend, okay, whenever the company earns a profit. But there is no fixed percentage of dividend given to the equity shareholders. Like, in case a company decides of declaring 10% dividend in this year, they will declare 10% dividend. Next year, if they want to declare 12%, they will declare 12% dividend. Okay, but for the preference shareholders, it is an agreement wherein a fixed percentage of dividend has to be paid to the preference shareholders, irrespective of if the company makes a profit or not. And dear students, coming to the debenture holders, as you all know, debenture holders are the creditors of the company. They are not the owners, but they are the creditors of the company. That means to say, now if ABC company has raised capital through the issue of debentures, they will have to pay a fixed percentage of interest to the debenture holders every year, whether they are in a position to make a profit or not. Every year, a fixed percentage of interest should be paid towards the debenture holders, dear students. Very important point. And whenever the company is closing down, whatever commitment they have towards the debenture holders, that has to be settled first. Why? Because they are not the owners of the company, but they are the creditors of the company. So I hope you're understanding. For the equity shareholders, you have to pay them dividend, but it is not a fixed percentage. That means it can vary from one year to the other year. And the equity shareholders are the actual owners of the company. But when it comes to preference shareholders, you have to pay them a fixed percentage of dividend, and whenever the company is closing down, you have to pay the amount that you're taken from the preference shareholders first, and then you can go towards the equity shareholders. And debenture holders, dear students, as I already told you, the equity share, the debenture holders are the creditors of the company. So that means to say, you cannot compromise with regard to payment of interest. You have to pay a fixed percentage of interest to the debenture holders of the company. Now, dear students, kindly remember, so even the equity shareholders will be having the voting rights. Okay, so that is one more privilege that is given to the equity shareholders. Now, dear students, I was telling you about the second point, that is deciding about the capital structure. So it means to say that a financial manager has to decide whether he is going to raise the entire amount of money through issue of equity shares only, or whether he is going to to raise the capital with a combination of equity shares and debentures, or he's going to raise the money through equity shares, preference shares, and debentures. So he has to decide about the capital structure of the company. Okay. Now, dear students, the third point, selecting the sources of finance or selecting the sources of funds. This is again a very important point. So, a financial manager, he has to decide from where exactly he can get the money, he can get the required sources of finance. Okay. So, once again, let me tell you, dear students, this is the subject financial management, particularly for the students who have taken finance specialization. Okay. So, and then talking about the sources of finance, so a financial manager has to decide about from where exactly he can get the required amount of funds. Okay, so as I told you, he can raise money either from his own capital, or he can borrow money from a financial institution, or he can, think of issuing shares, debentures, etc. So, how exactly he is going to select the source of finance is a very important concept. And dear students, selecting the pattern of investment. Dear students, also remember a financial manager should be very careful. He has to decide where exactly he is going to make the investment of funds. Okay, so because once he thinks of making investments, he must be in a position to earn a very good rate of return. So, a financial manager, it is again his responsibility to decide about where exactly he can think of making the investment. So, whenever the financial management manager thinks of making the investment decision, definitely he has to think about the safety of the funds. Okay, that he has to look about the take into consideration the profitability, whether the money that he is going to invest, whether it's going to earn him a good profit or not. He also has to look at the concept of liquidity. Okay, so that is about selecting the pattern of investment. And dear students, allocation of funds, administering the allocation of funds. Now all of you, please keep in mind, I told you that as a financial manager, he will have to decide about from where exactly, okay, he can think of getting the amount of money. So whenever you think about getting the money, only getting the money is not important. I told you that allocation of funds is again very very important. So when it comes to allocation of funds, what has to be done is, please keep in mind, a financial manager has to check whether he is allocating, that means whether he is putting the money properly and efficiently allocating whatever money is there. Okay, so that is about allocating the funds. And then dear students, coming to proper cash management. Okay, that is again another important point. So I told you that, see, cash is very important for any business. You should not have excess cash with you. You should again not have, a shortage of cash with you. So a financial manager should think about having proper cash management, so that the funds that are there with him should not be in excess, because I told you, if you have more cash, the chances of misusing the cash can happen. On the other hand, there should also not be shortage of cash, because if there is shortage of cash, the activities cannot be taken place in a systematic manner. And dear students, coming to the next point, cost volume profit analysis. What is this cost volume profit analysis? Now, see, now let us say it is a particular company. Okay, now a financial manager has to look into what is the cost of manufacturing the goods. Okay, let us say it is an industry which is manufacturing the goods. He has to keep an eye on what is the cost of producing a particular product, what must be the volume of production. That is again another point. And the third point, the profit, whether the organization is in a position to make sufficient profit or not. Even that he has to monitor regularly. So, cost volume profit analysis happens to be another very important objective of a financial manager. And dear students, coming to the next point, it is about dividend policies. What do you mean by this dividend policies? A dividend, just now I was telling you, see, dividend is a share in the profits of the company. Now, I was telling you about the equity shareholders. I told you very clearly that if I am the equity shareholders, I am investing money in a company. I am the owner of that particular company. I will be issued equity shares. But, dear students, please keep in mind the company will be making profits every now and then. Whenever the company makes a profit, it is the due responsibility of distributing the profit in the form of dividend to the shareholders. Dear students, if you are not able to understand the basics of theory part, you will not be able to understand the problem. Okay, so please keep that in mind, because immediately in the same class I'm going to start with the practical problems. But if you have not understood the concept of what is dividend, about the shareholder equity shareholders and the preference shareholders, you will not be understanding the problems. So please keep in mind that dividend is a share in the profits of the company that will be given to the shareholders. And first of all, when it comes to the equity shareholders, as I told you, dear students, the company can decide about what percentage of dividend can be given to the equity shareholders. See, some of the companies follow a stable dividend policy. That means every year a fixed percentage they can think of giving as dividend, or they can think of changing it every year. It depends upon the management perspective. And proper use of surplus. Dear students, one more important finance function is there should be proper use of surplus. Now, let us assume that you are having surplus money in your organization. If you are having surplus money in the organization, so it means to say that it is you can use that money maybe in the time of emergency. Okay, so what you need to do is, if at all there is excessive cash, you should decide about how this excess cash can be efficiently utilized. Okay, now dear students, let us go to the next topic, and immediately after that we will start with the problems. Okay, now there is one more very important concept, which is a question which will frequently be asked in the examination. Like, what do you mean by profit maximization and what do you mean by wealth maximization? Happens to be one of the very favorite questions which will appear every now and then in the examination. So you need to know the difference between profit maximization and wealth maximization. Okay, now dear students, please keep in mind profit maximization is a concept which mainly focuses on earning profit. That means to say, see, all of us know that profit is one of the main aims of any business entity. Okay, so any business enterprise, the main aim of a business enterprise will be to earn sufficient amount of profits. Okay, so the main intention of starting, of course, any business will be to earn as much profit as is possible. But profit maximization is a concept which will just give importance to earning more and more of profit. But, dear students, when you come to the concept of wealth maximization, see, wealth maximization is you are giving importance to the shareholders. So, when a company is following the concept of wealth maximization, it means to say it is giving importance to the shareholders. It is seeing whether the value of the shares of the company is increasing, whether the shareholders are in a position to earn sufficient amount of dividend. Okay, so wealth maximization happens to be a more broader concept, and here it is basically considering the shareholders. Okay, wealth, they want to maximize the wealth of the shareholders, because see, when I invest money in a company as a shareholder, what will be my intention? My intention will be that I must be in a position to earn a percentage of dividend. Now if there is no dividend given to me, definitely I will not be happy with that particular organization. So dear students, please keep in mind, wealth maximization is a very broader concept which mainly thinks about, focuses on the shareholders of the company. It aims to increase the value of the wealth of the shareholders of the company. Okay. Now, dear students, let us go to the next concept, and let me tell you that this particular concept called as capital structure. Okay. Now, capital structure happens to be the first topic wherein you can be having a practical question. So you can expect a 10 or a 15 mark question. You can expect. Okay. There can be a question or capital structure decisions. So let us start with this. Now, I was already telling you about what do you mean by capital structure. Okay, so capital structure is nothing but what is the financial mix. That means to say, when you want to start a company, whether you're only going to, whether you are only going to think about, including only equity shares in the in the capital structure, or will you be thinking of including the debentures, or will you be including a proportion of equity shares, debentures, as well as the, the preference shares, how exactly it is going to be like. And dear students, before going to the problems, the next very important concept is the factors affecting capital structure decisions. Now, this is also a very important point from your exam point of view. Okay, now what are the factors that are affecting the capital structure decisions of a firm? Now, you know very clearly, I was just now telling you that a company can think of raising money either through equity shares or with a combination of equity shares, debentures, preference shares, etc. Now, how are you going to decide those the mix of finance? It depends upon these factors. One is the internal factors. The second one is the external factors. Okay. Now, dear students, coming to the internal factors, the first point is the size and the nature of the business. Okay. Now, generally, what happens is, in case of the trading concerns, they can raise capital through issue of equity shares and preference shares. Okay, because these trading concerns will be requiring more working capital. So what they do, they basically think of raising the money, okay, in the form of equity and preference shares. However, large companies, they have huge investment, so they can think of issuing money either, through the issue of debentures also. Now, why large companies will be in a position to issue debentures, is that, you know, that a fixed percentage, okay, has of dividend has to be paid. I mean, fixed percentage of interest should be given to the debenture holders. So that can be done, okay, basically by the large companies. So please keep in mind, one of the important factors affecting the capital structure is the size and nature of the business. The next point is capital gearing. Okay, this is nothing but what is the proportion of debt and equity that you're going to adopt in your capital structure. Dear students, you should remember that there is an ideal debt equity ratio which is mentioned, okay, as per the guidelines. So it is 2 is to 1. That means if you have 2 lakhs in the form of debentures, you should have 1 lakh in the form of equity. So that is considered as an ideal ratio. So capital gearing is nothing but what will be the proportion of equity that you're going to adopt in your company's capital structure, and what will be the proportion of debt that you're going to adopt. And dear students, how the capital structure is required will also depend upon the requirement of capital. That means to say, see, in the initial stages, a company cannot think of issuing variety of securities. Why? Because there is lot of risk. But later on, now let us say if the companies think of modernization, expansion, it can think of issuing securities such as debentures also. Why? Because it is in the developing stage. And dear students, a company can think of raising finance by looking into whether it is having adequate earnings or not. Okay. Now, see, let us say a company is very well developed, it has a stable earnings. Okay. So, if that is the case, then it can make payment towards the fixed rate of interest towards the debenture holders. So, if your company is a well developed company, it is having sufficient earnings, then it will definitely not be a problem to raise the money through debentures. Okay, keep that in mind. Then the future plans and development. Again, when you have to decide about the capital structure of your firm, you have to think about what will be your future development activities. And for what period the finance is required is also very important. Okay, so please keep in mind that generally if the funds is required on a regular basis or a long term basis, they will think of issuing equity shares. But if it is for a shorter period of time, it is better to go in for debentures or for preference shares. Then, dear students, there is one concept called as trading on equity. What do you mean by this trading on equity? The trading on equity means the use of borrowed funds. Okay, borrowed funds means you can borrow money from a bank, or it can be basically in the form of debentures. So it is not that you should raise the capital of the firm only with the help of equity, but rather than that, it would be better if you have a combination of both debt and equity. And dear students, again, the capital structure of the company depends on the attitude of the management. Now, see, I told you that the equity shareholders will be having voting rights. So please keep in mind, if the company feels that no, we do not want to share the ownership of our company, they will not think of raising money in the form of equity shares. Why? Because you know that the more the number of shareholders, all those people will be having the control over the company, and also they will be having voting rights in the company. So it depends upon the attitude of the management also, and also it depends on the growth of the firm's business. Okay, now, at which stage of development your firm is, that is also very important. Based on that, you can decide about the capital structure. And dear students, the last slide, it is about the external factors. So when you're raising the capital structure, there are certain external factors which has to be considered. One is the market condition. Okay. So if the share market is in a very declining stage, what happens? It will become very difficult to raise the money through equity shares. Why? Because whenever there is a depression in the economy, so people will not have the confidence to invest money in the shares, equity shares. So that is why please keep in mind that if the share market is in the declining stage, then it is better to raise money through debentures. But on the other hand, in case it is a period of boom, the company can think of raising money through equity shares. And dear students, the capital structure raising also depends upon the attitude of the investors also. Okay, because only those investors who are having, looking towards high risk and high return, they think of investing in equity shares. Okay, and people who want to earn an assured returns, they think of investing money in the form of preference shares or debentures. Then the rate of interest. Dear students, the capital structure also depends on the rate of interest. For example, if you are borrowing a huge amount of debt, you have to pay a fixed percentage of interest. So you need to see whether you will be in a position to pay that high percentage of interest or not. It also depends upon competition. Okay, so if the firm is facing a lot of competition, it should raise the funds by issuing equity shares. Okay, why? Because you will not be, in case of equity shares, you need not pay them a fixed percentage of dividend every year. It is not compulsory. Okay, so it depends upon the competition that you're facing in the market, and it also depends upon the attitude of the financial institution. Yes, dear students, now see, you can also think of raising money by the bank, okay, or financial institutions. Now, in case you feel that, okay, you will be able to or get money easily from the bank and financial institution, you can always approach for that. But on the other hand, in case you feel that no, the process of obtaining loan is going to be a cumbersome or a difficult procedure, you can always think of going in for other sources of funds. And taxation, dear students, please keep in mind, whatever the interest that a company is going to pay towards the debenture holders, that interest component can be deducted as tax deduction. Okay, so why a company will think of raising money through debentures is that whatever interest that they pay towards the debenture holders, that interest amount will be exempt from the payment of tax to the company. Okay, that is one thing. Then, based on all these factors, dear students, they will decide about how to raise the capital structure, whether it is entirely through equity or entirely through debentures, or with a combination of preference shares, debentures, and equity. Now, dear students, I hope you understood these basic concepts, okay? Because now I'm thinking of going in directly to the problems. Now, coming to the problems, dear students, let me tell you very clearly. Now, I'm going to explain to you the problems which are basically there in your study material itself. Okay. Now, what I will do is, maybe if I try to work out the problem, it may take a long time. So, I will try to explain these problems step by step, so you people can make use of your study materials also, okay, which will be very helpful to you, because I've taken these questions from the study material itself. So let us go to the problems on earnings per share. Now, dear students, please keep in mind. So, one of the very important questions that can appear in your examination, either for 10 or 15 marks, is of course the problems which is relating to earnings per share. So, please keep in mind, you people have to give importance to this concept of earnings per share. Just a minute. Okay. I hope you're all able to see the screen. Yes. So I hope all of you are able to see the screen on the problems. Is it visible? Yes. Are you able to see these problems? Everyone? Can I start? Now is it visible to you?